How is everyone doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, we're going to be discussing the CFPB. What is their future? Do they have a future? A lot of things have taken place here over the last few weeks, and we're going to look at three key things today. First, I'm going to read you a couple of excerpts from a post from Emily McCormick, who's the vice president and editorial and research for Bank Director. We're going to look at a Bank Director article that basically talks about what's going on over at the CFPB. And then we're also going to look at just some reporting from CNBC that happened as of Friday, February 28th, just a few days ago, before the weekend, as we kick this week off, as it were. So, okay, so let me read these excerpts here from this. So, and this is going back a couple weeks. So as of Friday morning from a few weeks ago, the Consumer Financial Protection Bureau's office had been closed for the week by Acting Director Russell Vought. He sent workers home with strict instructions not to work. There's a freeze on communications, examinations, and investigations. Visiting the Bureau's website yields a 404 error, and over 100 million in vendor contracts have been cut, according to Bloomberg Law. Lori Lee Salas, the supervision director, and Eric Halperin, the enforcement director, stepped down after receiving orders not to work, according to news reports. Vought also declined the CFPB's next round of funding from the Federal Reserve, calling it excessive in a post on X. This spigot, long contributing to CFPB's unaccountability, is now being turned off. The CFP shutdown, temporary or not, has financial institutions in limbo, says Dow's Brad Rustin IV, a partner at Nelson Mullins Riley and Scarborough, who chairs the firm's financial services regulatory practice. He believes the nomination this week of Jonathan McKiernan, a recent director at the Federal Deposit Insurance Corp, to lead the Bureau would indicate some role for the CFPB in the near term. He says the Senate must confirm him. McKiernan would be well positioned to close up the CFPB's operations if Congress chooses to abolish it, Rustin adds. If you do plan to transfer the CFPB's role to the FTC and the Fed, he would have the expertise to do so. So that's kind of interesting. So again, Russell Vought was put in charge of the CFPB, but they also have this gentleman, Jonathan McKiernan, up as to be appointed as the next head. But let's pause on that for just a second. So now let's take a look at this article from the Bank Director, and this was called "Chaos Consumes CFPB, Causing Uncertainty. As leadership changes at the Consumer Financial Protection Bureau, banks are left waiting to see what rules might be undone." So the Consumer Financial Protection Bureau is going through a tumultuous period, and that's left banks wondering what to expect from the agency. Earlier this month, Russell Vought, the agency's second acting director since President Donald Trump's inauguration, shut down the CFP's offices and told employees to stop their work immediately. He also announced he would decline the agency's latest round of funding from the Federal Reserve. As of publication early Friday morning, all of the agency's probationary employees were let go. The potential for more layoffs continues to loom, although a federal judge has ordered the Trump administration to halt layoffs and other actions pending a court hearing. This is a significant shift from the previous administration, which fully embraced the work of the CFPB. Under Rohit Chopra, who served as the agency's director under former President Joe Biden, the CFPB produced a number of rules that frustrated the banking industry and resulted in litigation. In addition to that, under Chopra, the agency levied more fines than during the previous Trump term. From 2021 to 2024, enforcement actions resulted in roughly $3.4 billion in penalties, compared to less than $1 billion in penalties from 2017 to 2020 during Trump's first term, according to data from the CFPB website. It's likely banks will welcome a slower pace of new regulations from the agency and a pullback in terms of enforcement, but the current turmoil has also created confusion. So let's just pause on that for just a second here. It's likely banks will welcome a slower pace of new regulations. No, it's 100% certain that banks will welcome a slower pace of new regulations. And it is also a certainty that the CFPB has basically been out of control for 4 years and have basically been running around fining whoever they wanted to fine, sue whoever they wanted to sue, coming up with a lot of rules that a lot of bankers would agree were over the top, ridiculous, and complete overextension of the CFPB's authority and what they were created to do. So again, just wanted to put that out there for a second. So, but anyway, we'll continue here. So, There is clearly a reset, says Ivan Kalik, a principal and advisory at tax firm Baker Tilly's Audit and Accounting Services Group. I think overall the theme is wait and see for the banks for a little bit. It definitely will be very different for the next 4 years compared to the last 4 years. During a recent town hall at JP Morgan Chase & Company, CEO Jamie Dimon criticized the CFPB as having massively overstepped their authority. Oh, wow, there it is. According to Reuters, which reviewed a recording of the meeting, but Dimon also recognized the hardship for banks when policies flipped back and forth and argued that consistent policies were better, according to Reuters. The uncertainty is bad, says Eugene Ludwig, a former controller of the currency under President Bill Clinton and founder and CEO of the consulting firm Ludwig Advisors. Banks can gear up and follow the law pretty well if they know what it is. What is really difficult is trying to figure out, what does this apply? Will it ever be enforced? Will it be from the other banking agencies? That makes it chaotic for bank management and the boards to figure out what they should do. There are a few rules that were more recently finalized that seem to be particularly in limbo. These include a rule capping credit card late fees and another that limits overdraft fees. Section 1071, which relates to the collection of small business lending data, has 3 rolling implementation dates through this year and next, depending on an institution's volume of this type of lending. The rule prohibiting including certain types of medical debt in credit reports was scheduled to go into effect in March. It's likely that the new leadership of the CFPB would seek to tweak or vacate some of these rules and others, though no detailed plans have been released yet. To unwind a regulation, the CFPB would need to follow the Administration Procedure Act, the law that dictates how federal agencies create and enforce regulations, and that could take time. It isn't magic. The CFPB has to follow the rule of law, says Brian Fink, a lawyer at McGlinchey Stafford, who advises banks on compliance and regulatory issues. You have to follow the proper process. Additionally, Congress could look to roll back some of these regulations through the Congressional Review Act, which allows lawmakers to overturn final rules issued by federal regulators within a certain time frame. Republicans, who now control both chambers of Congress, have vowed to take this step with the cap on overdraft fees. Additionally, these rules have faced litigation that already threw their future into question, and these lawsuits could lead to their demise. In addition to closing its offices, CFPB leadership has stayed its legal work for the time being. That could mean the agency mounts a less vigorous defense of these rules or abandons these efforts entirely. Given the uncertainty, how much banks should prepare for these rules depends on how close the implementation date is, Fink says. For example, the medical debt rule is supposed to take effect next month. That means that the industry should be fairly far along in being able to abide by it, even if the courts vacate it or the CFPB decides to reverse it. If an implementation date is further away, then banks could slow their preparations to see what the CFPB's new leadership decides, what actions Congress takes, or how the courts rule. In general, banks should continue to follow any regulation that the agency has finalized and that has been published in the Federal Register. Failure to comply could open the bank up to regulatory action. This is true even if the CFPB itself takes a significant step back in its own enforcement. There are a number of other entities, including state attorneys generals, that could fill this enforcement void, and it seems likely that this could happen at least in some states. In January of 2025, just before he left his post, Chopper's agency released a document titled Strengthening State-Level Consumer Protections. It has been a roadmap for other agencies to follow to enforce consumer protection laws. Banks should also keep in mind that the regulatory pendulum is likely to swing significantly back in the other direction. If Democrats retake the White House because of that possibility, banks shouldn't completely gut their compliance departments and efforts under the assumption that there will be less enforcement in the interim. Experienced compliance officers are hard to come by, and it could prove difficult for banks to beef up staff. I don't think it would be a good bank management to say, last year we spent X on compliance, let's spend 60% of that and let loose those cost savings run to the bottom line, said Grayson Tuck, president of the law firm Garrett Smith Tuck. You may see some of that, but I would be wary of a bank doing that. 4 years from now, we could be talking about how the CFPB is getting the band back together again. There are hopes that the current chaos will be short-lived and that a permanent director will soon take over and bring clarity to these issues. Trump has nominated Jonathan McKiernan, who has served as a Republican board member of the Federal Deposit Insurance Corp since January of 2023, to lead the CFPB on a permanent basis, though he still needs to be confirmed by the Senate. If confirmed, McKiernan seems likely to be less aggressive in rulemaking, and he has made statements in the past critical of overregulation of the industry. I think the Trump administration isn't going to change the mission, but how they do it, Click says. There is a balance of protecting consumers and protecting investors, and those missions are critical to our economy and trust in the capital markets. There will be some time to allow the new leaders to get into place and see what the new direction and changes will look like. So, yeah, I think some of this is a little bit over the top at the end of the article. Like, I don't think any bank out there is going to be cutting 60% of their compliance budget and laying people off just because the CFPB has been put on pause here for the moment. But let's take a look at this real quick. So this is some reporting that came out from CNBC on Friday, February 28th, the end of last week. So it says Trump administration, Musk's DOGE plan to fire nearly all CFPB staff and wind down the agency, employees say. So the Consumer Financial Protection Bureau's Trump-appointed leadership plans to fire nearly all its 1,700 employees while winding down the agency, according to testimony from employees. In a trove of statements released late Thursday, federal employees said that the mass layoff was discussed in meetings they attended this month with senior CFPB leaders and members of Elon Musk's so-called Department of Government Efficiency. The filings were made in the case started by CFPB's union that suspended acting CFP Director Russell Vought's moves to shutter the bureau. So the Consumer Financial Protection Bureau's Trump-appointed leadership plans to fire nearly all of the 1,700 employees. But let's skip down here. So DOGE said the plan for CFP leaders and DOGE was to cut the Bureau's workforce in 3 phases. It would first eliminate probationary and term employees, then carry out a wave of about 1,200 layoffs, leaving a skeleton crew of a few hundred workers. Finally, the Bureau would reduce altogether with 60 to 90 days by terminating most of its remaining staff, DOGE says. The workers' testimony comes at a critical time for the CFPB, the agency created to protect consumers after the 2008 financial crisis caused by irresponsible lending. Since DOGE operatives first arrived at the CFPB this month, the Bureau has shuttered its Washington headquarters, initiated the first round of layoffs, and told those who remain to stop nearly all work. The department has also reversed course on several cases where it accused financial firms, including Capital One, of ripping off customers, dismissing at least 4 cases Thursday involving billions of dollars in alleged consumer harm. The filings containing the employee statements were made in the case started by a CFP union, which led to a judge suspending acting director Russ Vought's moves to shutter the Bureau. After the CFPB fired about 200 probationary and term employees, the agency's actions were put on hold until a March 3rd hearing. Okay, and then it goes on from there and basically just says, okay, here's what's happening, or here's what's going on there. So here's the interesting thing. The CFPB has 1,700 total employees. Like they said, they already fired 200 employees that were on a probationary status. So now you're down to 1,500. By law, the CFPB is only required to have a few hundred employees. I think about 200 or maybe 300 employees. So 12 or 1,300 of those employees are going to be gone. They're going to be let go very, very shortly. There's going to be some stalling with courts and lawsuits and stuff like that. But I think ultimately those employees are going to be gone, and you're going to be left with a very small CFPB with, like they said, basically a small skeleton crew of probably 200 to 300 employees remaining. But it definitely sounds like they are leaning towards shuttering the CFPB, or dramatically reducing it to a point where there's not much left. So and then it becomes up to Congress. Then the ball's in Congress's court to see basically what will they do with this. Will they look to shutter it, to roll back some of the rules that have already been implemented, as we looked at in the bank director article. That's a lot of stuff that's up in the air. And obviously, Congress generally does not move lightning fast on a lot of these things. So I do think that this is something that we will see play out over the next year or so. Certainly whatever happens, I think will get resolved by Congress, before the midterm elections. So that would put this on track to something happening within the next year and a half. Because by June of next year, as we get to about 6 months out from the election, pretty much everything, comes to a stop as all the politicians go into batten down the hatchet modes during election season. So you probably got about a year and a half to see if something happens with this. And yeah, but like I said, not looking that great for the CFPB. But again, I'm not, I'm not shedding any tears for the CFPB. One less, one less regulator to worry about. Not the end of the world. But that's a story. That's the story what we got today. And like I said, so with that, we'll continue to follow this and see what happens. I'll bring you more information in the weeks ahead. But if you like this episode, please make sure to like, share, and subscribe. Remember, we are on Rumble, YouTube, and all major podcast platforms. Please be sure to leave your comments down below, as I always love hearing back from everybody. And make sure to check out some of the other content on the channel. But thanks a lot for listening and watching, and I'll see everybody again real soon.